You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplified ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey everyone, welcome back to another episode of Market Champions. Today we've got the man, the myth, the legend, the Convexity Maven himself, Harley Bassman. Harley, thank you for being on the podcast. It is awesome to have you.
Good morning. Good morning from Quag. It's very peaceful, and I have my glasses on still. So early morning, but glad to get up for this.
Awesome. So Harley, you've had an awesome career on Wall Street. You spent 26 years at Merrill Lynch. So for the people in the audience who might not know, could you just give us a brief synopsis of your career?
Well, I looking at you and the audience, I suppose I'm talking to, I'm one of those baby boomer locusts, so happy to go and eat all the available crops. Grew up in California, went to school in California, went right away to MBA at U Chicago. So I'm a monetarist, a Friedmanite. And I went to, you could do that at the time. You can go right to business school. That doesn't happen anymore. Yep. Ended up on Wall Street at age 23. I was at Drexel for a little bit. Mike Milton, who's probably way before all your time, he was in California and that's almost a separate entity from those in New York. And at the time, there was on the entire Drexel trading floor, there were 3 IBM PCs that used a floppy disk. There's probably 5 of us who actually plug it into the wall, and I was one of those. And I actually wrote the beginning bond option pricing for it in BASIC. I was there for a couple of years, and then ended up at Merrill Lynch in 1985, and was there for 26 years. While I was there, I ran mortgage trading, option trading, and other various things. Anything where the payoff profile was not linear. So that means there was convexity to it. And for all of you people who hate math, convexity is a second derivative, but all it means is it's not a straight line. So if you think of first derivative, we call it delta. That's velocity, right? It's a change in location for a change in time. So you move 20 miles an hour. Every hour you go 20 miles. Acceleration, second derivative, is the change in velocity. And so when people talk about delta or gamma, that's all they're talking about is velocity or acceleration of an asset relative to its price and its time.
Yep. And while you were at Merrill Lynch, you sort of lived through, I guess, the proliferation of these mortgage products. So what was that like? And how have markets in general evolved since you were at Merrill Lynch's desk?
Well, there are a few books you're supposed to go and read. One of them is the Yield Inside the Yield book by Homer and Leibowitz. The other is Marcia Stigum, which is probably outdated, but describes the money markets. And then, of course, there's the book about all the Wall Street fun and games in the late 80s. And I will just say those were all true. It was kind of Wild West back then. But what really was going on in the late 80s, early 90s was I guess applying math to investing. Before then, it really had been, do I like a company or not? Do I think rates going up or down? But there really was no science to finance. And this is what I kind of fell into by accident. And why in the 90s, most of the people we hired, well, not most, many of the people we hired were people with physics PhDs, literally rocket scientists, to go and figure these things out. So for example, I'm a mortgage guy because mortgages they're convex because they're callable. When you're a homeowner, you buy a house and you take out a mortgage, you could hold that mortgage for 30 years, or you could pay it off at no cost anytime. So it's really a 30-year bond that can be called from you, can be collapsed any single month. That's very hard to price unless you have advanced math skills and some modeling techniques. And that's where I got involved in this nonsense. And so if you have, let's just make up an example. If you have a security or a bet or anything, it can go up by $1 or down by $1, even odds. I'd call that a zero convexity bet because you make lose the same. Yep. If you could make 2 or lose 1, let's call that positive convexity. If you could lose 3, make 2, call that negative convexity. So the question really comes down to, okay, we've agreed that these are the securities. We've agreed that the payoff profiles given changes in rates or changes in assumptions. The question is, what should the price of those things be? So if the instrument that goes up 1, down 1 yields 5%, what should be the price or the yield, because we talk yield terms in bond land, of something that goes up 2, down 1? It's got to be less than 5, because if it was 5, you'd always buy that over the other one. Should it be 4, 4.5, 3? I don't know. Well, that's where you apply the modeling. If it can go down 3 and up 2 for equal changes, equal movements, it ain't going to be 5 either, because you'd never buy it then. It's got to be higher. It's got to be 5.5, 6, 7, some number like that. And this is where you apply option theory and physics and modeling to try and come up with what we think to be the theoretical fair value of different securities that have different non-linear payoff profiles. And that's really, that's my entire career, is basically trying to figure out what the yield should be for different payoff profiles, or what the cost should be. When we talk about cost, we usually talk about what the price of the option is. So that's it. It's actually fairly simple if you kind of break it down into its core components.
Got it. And you talk about payoffs. You sort of talk about bonds, and when you talk about bonds, you say that there are 3 ways to get paid. And could you just sort of summarize that as well?
Sure. So when you think about any kind of investment, bond investment, but actually really almost any other investment works the same way. You have duration, credit, and convexity. So duration is when you get paid back. So should I buy a 1-year bond, a 2-year bond, a 30-year bond? Usually you don't ask for the same return given different maturities. If you go longer in maturity, longer in when you get paid back, you should get a higher yield. Usually, not always. That's a little more complicated later on. There's credit. So bonds on IBM, on Apple, on Google, junk bonds. That's will I get paid back, right? I mean, when you buy a Treasury, you know you get your money back. Yep. If you buy something else, maybe you don't. So you should get an extra yield for anything that's not a Treasury bond. How much? Once again, need some modeling to figure that out. What are the odds a company goes bankrupt? When might it go bankrupt? Or even not even bankrupt. When might they not pay you your money back? Yep. And then there's the how you get paid. I call that's convexity. And that's the path of how your investment plays out. So you have duration, credit, convexity, when, if, and how. So I break things down into those components. And if you look at any kind of investment in bond land, there will be the Treasury security is your risk-free rate, your base rate. And then you add on your other risk vectors to that and try and get what it's supposed to be. And then in theory, if something's trading below its theoretical value, I'll buy it. And if it's trading above, I'll sell it. So we often don't really get caught up in is the price going higher or lower? Is there good news or bad news? It's just a relative value game on Wall Street. Yep. So that's kind of what we do.
Got it. And you also like to say that you're not a fan of TIPS, the Treasury inflation protected securities. So could you talk a little bit about why you're not a fan?
Oh God, there's a zillion reasons. I mean, in a nutshell, I mean, so for those not familiar, a TIPS, Treasury inflation protected security, is basically, so you buy a 5-year TIP. You could buy a 5-year Treasury that pays, I'll make up a number, 2%. Okay. A TIP will say, okay, I'm paying you some number plus inflation. Inflation as stated by the US government every month. Not your guess of what the number is, but what the government reports. That by itself, I'm not bothered by the concept. The problem I have is with the actual CPI number. I think CPI is I'll call it a manufactured number, which by definition it is, but I'm uncomfortable with how they do it. And they use things like hedonics and substitution, other things to create this number. My belief is that the government has intentionally understated inflation, understated CPI for two reasons. One, hearing a high CPI, high inflation number is depressing, so you don't want to give bad news. But more importantly, the government bases a lot of their transfer payments, Social Security, et cetera, on a COLA, cost of living adjustment. And to the extent they could dial down that COLA, which is driven by CPI, they will owe less money to people in the future who would prefer to go and reduce spending as they can, so they can spend money else places that they think are a higher priority. So as a concept, am I against that? No. As a public policy measure, is that good for the government? Yes. It was a way for us to go and control the exploding cost of Social Security, Medicare, and other government mandatory programs. But do I want to buy a security based upon that CPI? Well, the answer is no, I don't.
Yep. And so what are your views on inflation going forward? Over the last, say, 15 months or 18 months, we've seen an insane amount of fiscal stimulus. We've seen an insane amount of monetary stimulus. So, are you expecting inflation to go up, both from a consumer goods standpoint as well as an asset inflation standpoint?
Well, I'm a U Chicago grad, as I stated. I'm a monetarist. Milton Friedman's famous for saying that inflation is everywhere and always a monetary phenomenon, which I agree with. I agree with the idea that if you print fiat currency, and it doesn't even mean dollars, the coin of the realm, so sticks and clubs are shiny objects, 5,000 years ago, whatever that might be for transacting, this is direct barter, where I give you some crops and you give me a hammer. That if you make more of that instrument, that exchange vehicle, if you make it faster than the growth of the underlying economy, you'll get inflation. So if you have X dollars, X loaves of bread, if you double the amount of dollars, but leave the number of loaves of bread unchanged, if that's the only thing that exists in this closed economy, then the price of bread will double, because it has to, because demand doesn't really change and you've made more dollars. So that's the big idea. What people are saying now, some of the more clever people, some of the less clever people, is that we've had no inflation despite a massive increase in the amount of dollars in the system as created by the Fed, because that's what they do. They are the owners of the dollar. They print it. It's a liability to the government. And they've been printing it at a massive pace, much faster than the growth of the economy. Why has there not been inflation? People will ask. The CPI really has been like, 2 and change for the last decade. My answer is, of course there's been inflation. There's been massive inflation. It's just not in the basket of goods CPI measures. I mean, groceries or computers or TVs or cars, they've gone up in price, but not that much for lots of reasons. I mean, some of them primarily is we're importing them from foreign countries, but even ignoring that, these things have not been in demand in the economy. Where has this money gone then? It's gone to the stock market, gone to the bond market, gone to gold, gone to art, to jewelry, lots of fixed items, land. That's all gone up in price dramatically in the last 12 years. So to say there's been no inflation is totally false. There is inflation, just not as CPI measures it, which once again, another reason not to buy tips, because tips are only paying you based upon CPI, which is a very narrow basket of goods from the government, which I'm not, once again, it's not bad per se, it's as it's designed. I would say there's been no CPI inflation, but there has been massive asset inflation. And this, of course, has led to part of I don't like getting involved in politics because that's a no-win scenario. But as I joked before about the locusts, of baby boomers, what you've seen is a massive increase in asset prices, fixed asset prices. And ignoring whether these assets are distributed by race or education, the cold reality is that older people have assets because they've been working for a long time and saving. Whether they're black, white, green, or purple, Muslim or Jewish or Christian, doesn't really matter. If you're older, you have more assets because you've been around longer. And thus, this elevation, this inflation of asset prices has benefited the boomer generation by definition. And I would argue at the expense of the millennial generation. What you've seen is most poignantly, I have 4 kids. They're all of that age where they're about to go and form families and buy houses and cars and babies and everything else, is you've seen an increase in housing prices much quicker than the increase in the price of labor. And even though they're not tilling fields, they're working at Google or the National Labs or Microsoft, wherever, those wages have not increased as much as housing has in the last 10, 15 years. And is that a public policy good? No, it's a public policy disaster. And so as I wrote in my last commentary or open letter to the Fed, I started citing a number of different ideas the Fed should do to ameliorate these problems, to go and reduce the way that their policies, which are well-intentioned, let's be clear, none of these are evildoers at the Fed. Other parts of the government, the Congress, the presidency, maybe a little rough on the edges, but the Fed has been fairly good at what they're doing in their intentions. The problem is once you make the money, it's hard to control where it goes to. And so you've had this unfortunate result where you have increased the value of assets, or the price, not the value, the price of assets relative to the price of labor. And you've created wealth disparity, which usually does not end well.
Yep. So I have 2 things on that. So at the start, you said that, you're a Friedman. You believe in the, Friedman said inflation is everywhere a monetary phenomenon. But, Friedman assumed that the velocity of money, the rate at which, people spend that money would stay constant. And we've seen that, drastically decline since the 1990s. So does that render, the monetarist model sort of obsolete? And then the second thing is, why is the Fed, in your open letter to the Fed, you suggested that the Fed slow down the rate of buying MBS securities. So, in spite of the strong housing market, why is the Fed buying MBS securities? And does that actually spill over into, higher housing prices?
Well, working backwards on your questions, there is no question that lower mortgage rates make higher housing prices. So reported recently, the median, not the average, the median home now costs $365,000 more or less. It depends which survey you use, but that's a ballpark number. And if I assume and what I'm thinking about here is that nobody buys a house. Well, some people buy houses, okay? These are the rich, but really civilians do not buy houses. They buy a stream of payments. They agree to a deal where they will go and write a check to someone every month for 30 years. They can pay it off early if they want, but that's usually the deal we have in this country. And in the time they own a house, and during the time they can live in this house. If they can afford $2,000 a month, I'm making a number up out of clear blue sky, that's what they can afford. Wages in general do not move that much. If for basketball players, they do, but in general, your wages, even if you work at Google or Microsoft or Apple, do not move that much from year to year to year. Therefore, that number, $2,000 a month, that's what you can afford. It doesn't change. You could then take that $2,000 a month and work backwards to how much house can I buy? I could say, well, $2,000 a month at 2.5% means I can borrow X dollars. And then those X dollars can be 80% of the payment. And I have the down payment, which is another story entirely. And there's your house price. If I said that you could afford $2,000 a month and you could buy, and you get a 2.5% mortgage, and you could then buy a house that costs $365,000. If I took that rate from 2.5 to 3.5, if I kept everything constant, so the homeowner was still paying that number unchanged, he could only now buy a house that cost $320,000. That's it. So you can see how lower rates, because they're down about by 1.5 in the last 2 or 3 years, has elevated housing prices from 320 up to 365. Actually, if I look at the real numbers, it's more like 300 to 365. So you have a 20% increase in housing due to lower rates. Oh, by the way, housing prices last year increased by 24%. Wow, that's almost magical, isn't it? Because if you include ordinary inflation plus the rate change, nothing changed at all, except the price of the house, because the wages people were earning were unchanged, more or less. So that's kind of how it all works. Why is the Fed buying mortgage securities? It's a public policy good to have people own their own homes. And the government encourages this by various tax breaks. You can deduct the taxes, the interest payments. You could do lots of other things where it's beneficial to own a house over renting because of tax policy or other government policies. And you probably end up with more stable families and everything else if people own their own homes. So as a public policy good, we, the government, like to go and make it easier to buy a house over renting if you can, dollar for dollar. And as I noted, interest rates drive that process. So lower rates means it's easier to buy a house. If a 2.5% rate means you could buy a median family house, if house prices don't move and rates go up to 3.5, well, now you can only buy a $320,000 house. There's many fewer houses available for you on that spectrum of house prices. So to the extent the Fed is lowering interest rates for housing, they make more housing available to more people. And that's a public policy good. Have they driven it too far? Yes, they have. And you can tell that by various ways, looking at what proportion of the mortgage market does the Fed own, which has increased dramatically. And have they pushed rate, and what is the value of a mortgage security now? If you actually do, and I don't want to get too deep into this, but if you actually do the dirty math of a mortgage security, they're actually about almost 0.5% too low relative to where they would trade in the free market if it was unchanged, relative to a Treasury security. And that's how I measure it. And I've written about this a few times, where I talk about CMM, constant maturity mortgage, versus CMS, constant maturity swap. Just trust me on this. We're not going to go there. But mortgage rates are probably about 35 to 50 basis points too low. Thus, linking together my previous story here, you've made housing prices 10 to 15% too high. And since millennials are now in that household formation, millennials get married about 5 to 7 years later than previous generations, and they are now right in the meat of the household formation time. And we've made housing prices 10 to 15% too high relative to where they should be. So that's the story, linking that whole process together.
Got it. And how do you discount or disaggregate demographics into this inflationary deflationary force, especially as it relates to housing? Does slowing demographics actually make a difference to housing prices in a world where, as you've explained, the Fed is suppressing mortgage rates here?
You guys know that I now work for Simplify Asset Management, and I joined there 6 months ago. I joined with my personal friend and colleague, Michael Green, and he and I will debate endlessly about demographics. I have stated for 5-8 years now that demographics are going to be rolling up again in 2023 and 2025, that the boomers are retiring, and that an inflection point 2 to 4 years from now of boomers retiring, inflected versus millennials entering the workforce, will create a positive labor force growth rate, an increasing labor force growth rate. And I have nice charts and graphs showing how labor force growth rate relative to inflation or interest rates are very well linked over the last 50 years, 60 years. And by the way, when did we have the last great inflation? It was the
70s.
80s.
Yep.
And when was that? That's exactly when the boomers were turning age 30, their household formation peak, when they would buy a house, buy a car, buy a washing machine, have a baby, buy a baby stroller, all those various things. So you had this massive demand for household formation goods being supplied by a smaller generation of World War II veterans. What you're going to have happen now is the same idea, a little smaller, where millennials are going to be demanding goods from a shrinking supply of boomer workers. And that should, in theory, increase inflation as aggregate demand increases relative to aggregate supply. Now, Michael has noted that there is a declining overall macro trend of declining demographics. That's true. What I'm saying is within that declining trend, you could then micro look at boomers versus millennials and see that inflection point there. Am I right? I don't know. I think I am, but I'm not certain. But if I am, you're going to know in 2 to 4 years.
Got it. And so, do you ever think that so you've written about a memo on your Convexity Maven blog called Blind Faith, which talks about the markets pretty much have blind faith in the Fed to sort of do the right thing for markets. So when do you think we're actually going to see a taper or a hike of some sort?
I don't know, man. I mean, the problem you have here is we have developed, I don't want to call it an open like addiction to the Fed, but we kind of have. We are a highly levered financial economy. And that leverage ratio, the borrowing, non-financials, not Wall Street borrowing money to go buy stocks, but just general leverage of corporate borrowing, household borrowing, government borrowing has been expanding relative to the size of the economy for many, many years. And it's expanded even faster in the last 5 to 10 years. It really accelerated, a year and a half ago with COVID. Was it a good idea for the government to step in and massively spend money? Yeah. Was it a good idea for the Fed to go and massively expand their balance sheet by borrowing, by buying, by lending, by lowering rates? Yeah, it was. What's the cost of that? And that's kind of the issue is how do you balance this out? When someone is sick, when do you go and wean them off the medicine? When someone cuts themselves, when do you pull the Band-Aid off? You pull it slowly or quickly. If you pull it too soon, maybe it gets infected. It's unclear. I do know that this cannot go on forever, that we cannot print money at a faster pace than the economy. But could it take 30, 40 years? I suppose so. I mean, Rome took 400 years to fall apart. Why can't it take us, a long time also? We are the largest economy, the biggest army, and we print the reserve currency of the world. It could take quite a while for really bad things to happen to us. People like me say we should try to go and wean ourselves off of these things because clearly, as time goes by, the problem gets bigger. And the corollary is you create what's called moral hazard, where people take too much risk because they think that someone else will protect them and that the costs of bad things happening will not be borne by them. So going back to 2004, 2006, 2008, we had the Fed come to the rescue after the market, the dot-com bubble in 102, and they did various things. And then they said, we're going to start raising rates. This is the important word here, pay attention, at a measured pace. The head of the Fed, we're going to raise rates at a measured pace. A measured pace means I'm taking rates up 25 basis points, 0.25%, every 6 weeks for some amount of time. Now, it used to be in the good old days that the Fed would take actions. I mean, once upon a time in the 80s, they wouldn't even announce they'd changed actions. You had to go kind of figure it out and guess by various things they did. They actually didn't put a number, a target Fed funds rate. They just did stuff. Then they went to announcing what their rate would be. But you still never knew what it was going to be. Could they be unchanged? Could it be up 25, up 50? In 1994, when Orange County um, blew up in California. That's another great story for old timers. What happened was the Fed did a surprise rate hike in February of 1994, and people who had borrowed money and were leveraged via this borrowed money, so the movement of their securities would be elevated. So in the good, if you own an ordinary security, you might go up and down by 1 point. They had levered it, so go up and down by 5 points. So if you own the same amount of dollars invested, you could make or lose 5 times. That's great when things are going up, but in going down, you have a problem. And these guys had a bet that rates were going to stay flat to go down. And when the Fed did a surprise rate hike, kaboom.
Yep.
Greenspan goes and says, I'm going to move at a measured pace of 25 basis points every 6 weeks, because the Fed meets every 6 weeks. What happens? Well, basically, you can go and you can lever up the yin yang because you know exactly what's going to happen. And you have no risk per se because the Fed's told you what's going to happen. So if they're going to take rates up by 25 bips, well, you could sell a 30 basis point out of the money put a gazillion times because it'll expire worthless because they've told you what to do with rates. This created over leverage, over speculation in 04, 05, 06, 07, which showed up in the borrowing in housing market. And thus, when things went a little haywire, everybody was way over their skis. Like, why would Merrill Lynch, which is where I worked for 26 years, why would they own 45 billion in CDOs when they only have 35 billion in capital? This is like utterly insane.
Yep.
Because they thought that they were totally safe in doing it with the Fed at their back. All these Wall Street firms, almost got wiped out because they had taken what the Fed had said literally, that there would be no surprises and that they could map out what's going to happen over there. We're doing the same thing right now. But when it ends, who knows? And should one and what's shocking about the whole thing is the price of insurance is so incredibly low. That's the anomaly here. Is we all know that the Fed and the U.S. government is doing, I won't call it risky things per se, but things that have outcomes that are not optimal. And these outcomes could turn bad given certain circumstances. And people are looking at the Fed and looking at the government saying, it's okay, they've got our back. We used to call it the Greenspan put, right? The Bernanke put. Now it's the Powell put or the Yellen put. Put option being the right to be protected, a big soft, cushy mattress underneath you in case you fall. When you have that, all of a sudden you take more risk. We're doing this right now. But as I said, could it end in 2 weeks? Yep. Could it end in 10 years? Sure. You just don't know. People always ask me, when will we see the next surprise? And the answer is, well, by definition, if I knew, it wouldn't be a surprise.
Yep.
So it's a nice question, but we really don't know. What we do know is that we are going to make the surprise unpleasant because of the leverage in the system. And so my advice is to find ways to delever and protect yourself by buying insurance in various ways. And that's what Simplify does, is we offer products where you're long the insurance policy, you're long the options as opposed to short them.
Yep. And one more thing that you have mentioned in your open letter to the Fed is that the Fed should allow the yield curve to steepen a bit more. And what this would imply is that long-term yields start to go up. And since you just gave us the picture of the highly leveraged economy, wouldn't yields going up actually be negative, as the cost of financing this already over leveraged system that would start to go up? So wouldn't that start to have a negative impact? And then how far would the Fed have to sort of start or stop influencing Treasury markets for us to get the signal value of the yield curve back?
Second question is kind of unknown. The first question is, the reason why the Fed or the government in general takes interest rates down during a recession is to go and lower the cost, lower the hurdle of starting a business. It's much easier to start a business at 2% than starting at 10%. If only because at 2%, you owe so little money back, you could borrow the money and maybe have 2 or 3 years to get the business rolling. Whereas if you borrow 10%, if business doesn't start working immediately, you're kind of cooked.
Yep.
So the idea that lower rates create animal spirits to get more businesses started, people take more risk to, let's just say if a new factory will earn a 5% return. If rates are 7%, you're not building a factory. If rates are 3%, you can build the factory, hire the people, and make your money. So that's the idea of Fed moving rates. What I would argue is that with 10-year rates at 135 right now versus rates being at 3, I don't think that makes a darn bit of difference for starting a business. Now, rates at 8, yeah, that'll make a difference in the economy. I don't think taking rates up by a couple points is going to matter at this stage of the game. And so the benefits you get from releasing the curve and letting it find its natural level, there's a few things. One, it makes pensions, insurance companies more stable, viable, because they rely upon higher rates to fund their activities. When you buy a life insurance policy or something else, you're putting in money today to get paid back in 40 years when you die. If an insurance company can earn 4% as opposed to 3%, they can charge less. If someone's buying long-term care health insurance, if rates are 4 versus 2, it's a lower price for the long-term insurance. And if people buy long-term care insurance, they will not go on Medicare, Medicaid in the future. So a positive outcome for the government. When you steepen the curve, retirees, boomers who are retiring now, can earn more interest. So they'll be less reliant on Social Security and other government services. Once again, a good. People who save can make money. It will be funded by people who are borrowing. But once again, I don't think going rate take rates from 1.5 to 3.5 makes a whole lot of difference for building a factory. Will it reduce profits for those businesses? Yes, sure, but it's always a trade-off. At this stage of the game, we're probably taking too much from the savers to give to the borrowers. And then finally, as you noted, the best so far predictor of the economy, of recessions, is the yield curve.
Yep. And
when the yield curve inverts, so the 10-year rate goes below the 2-year rate or the 3-month rate, you can measure it lots of different ways. You tend to get a recession in a year and a half, more or less.
Yep.
I wrote about this, so in case you guys are familiar, I publish a macroeconomic commentary on Convexity at Maven.com. I have my 10, 15 years of commentaries there. If you want to be added to it, please email me at harley@bassman.net. And I wrote about this exact thing in 2019. And I said, we're going to get a recession sometime in the first or second quarter of 2020. I said, I have no idea how to explain it. Everything was great at the time, is what it is. But, in November, December of 2018, we had, the curve inverted.
Yep.
And lo and behold, we had a recession in March, April of 2020. Now, I don't think the yield curve predicted a pandemic, and I will not take credit for that. But I will say that it did happen, and that will count as a win. And someday in the future, when we're looking at correlations of yield curve to recessions, that number will pop up as it happened basically in 18, 19 months after it was predicted. I didn't predict it. I just noted the curve's inverted. When you get curve inversions, you get recessions in 18 months. That was just, I didn't predict per se. I just said, here is this, and there's that. And so when the Fed is artificially suppressing interest rates and controlling the yield curve, we lose the information content of the yield curve. And I think that it's unclear to me how investors, or more importantly, how public policy makers can decide actions to take if they don't have clean, clear information coming to them. The information they're getting is soiled because of their policies, and therefore is really almost useless.
Got it. And so, with this sort of framework in mind, Fed suppressing rates, Fed printing money, driving up asset prices, the immediate sort of reaction of most people is to jump to something like Bitcoin because that's going to stop the Fed and the government from intervening in markets. But interestingly, you are a critique of Bitcoin. So could you talk about, why you're not a fan of Bitcoin, especially because you share these views on the Fed?
Well, look, Bitcoin, I don't know, is now 40, 45,000. Could it go to 100,000? Of course it can. Sure, why not? Go 200,000? Be my guest. Don't care. What I'll say is that Bitcoin is not the solution to fiat currency. In some sense it is, I suppose, because it's nothing printed. But the reality is this. Let's talk real politics. When you think about a country, what defines a country? It could be their borders, language, religion, could be their race. Lots of could define a country. I would say that one thing that defines a country often is its currency. The government controls its currency. It's how we in our country transact and trade.
Yep.
Okay, we don't have it anymore. We have direct barter where someone gives you milk and then they give you an orange, right? Mm-hmm. We use money, and we use money also for delayed purchasing. So if you have a huge win, if you make money, you have a ship and you go find treasure and you find your money. Well, you spent 5 years looking for the treasure, you get the money in. You're not going to make another treasure for 5 years. So you need to go and delay your purchases, your ability to buy bread out 5 years. Coins, currency, money gives you the right to go and store value for a later time. So Bitcoin has two problems. Number one, it ain't the store of value because it's way too volatile. But more importantly, Bitcoin is owned by nobody or everybody, I suppose, but it's not owned by the government. And so therefore, what it really is an active war against a sovereign state. Bitcoin is an active war against the US government, against Russia, against China. Now, Russia and China are already starting to kind of rein it in. I can assure you that at some point, Russia and China will collapse Bitcoin. They're not going to allow it. I mean, they don't allow free speech and free communication and free information. How are they going to possibly allow undetected money transfer? I mean, they're already basically forcing people out of cash and into using some kind of payment system so they can track all spending. Where the hell are they going to allow you to go and trade and use Bitcoin? That's not going to happen. And by the way, in those countries, they don't go and knock on your door and ask you politely. They go and shoot you. In the US, we're not going to quite go there. But what's going to happen probably is some kind of taxation system where they're going to go and make you disclose any transaction over a certain number, which they already do. By the way, you go take out 10,000 in cash from the bank, that is disclosed to the government. And they'll do that. Remember, Al Capone was the biggest bootlegger in the 20s, right? And he was the murder and robbing and killing and this and that, but he didn't go down for any of that stuff. We did jump for tax evasion. That is the likely path of how the US government controls Bitcoin, is by making it reportable, disclosable. You're going to have to go and produce an FBAR, which is the statement you have to, if you have a foreign bank account. You can have an account in Europe or anywhere. It's not illegal to have a bank account based in a foreign country. Mm-hmm. It's just illegal to go not tell anybody. And you have to go file an FBAR every year to state if you have an account over X $1,000 in a foreign country. No one cares. But if you don't tell them that, well, then you go to jail. Bitcoin is in essence a foreign bank account because it's not US domiciled. Therefore, It's really not. I mean, is it in the other country? I suppose not. But the reality is it's not a domestic bank. Therefore, it's a foreign bank. And that's what they're going to go and do, is my prediction. And once you do that, then you kind of defeat the purpose and you end up back where we already have a US dollar-based electronic currency. It's called Venmo.
Got it. So, being a freedman, I'm guessing you're probably some sort of a proponent of fiat currency. So what would your ideal, monetary system look like? Because, you're not a fan of Bitcoin, and I'm guessing you're not a fan of the gold standard either. So what would the Bassman standard look like?
I mean, you know, the issue there becomes a public policy construct of how do you want to go? Because the money system you have goes hand in hand with your tax system and your spending system.
Yep.
So as much as I would say that MMT, modern monetary theory, is once again another, I don't want to say bogus idea, but another, concept that sounds better in theory than practice. I think that, determining our tax policy and our spending policies go hand in hand with our money policy, because how you spend the money, how you collect the money, it's all one thing. Should we have a flat tax? Probably not. Should we have a highly progressive one? That kind of makes sense. At what is the number where it's too high? I don't know. Are we close to it? I think so. I hope so. But I mean, maybe not. I mean, we had 90% tax rates in the 60s. And we survived that. Of course, the level where we hit that 90% was like $5 million adjusted for inflation. Social Security, Medicare benefits, where do those kick on in? If you go look, I mean, the bulk of our budget now is mandatory transfer payments from Medicare, Medicaid, and the like. If you take the 1936 actuarial tables, where we had a 65-year start date for Social Security and put it in today, it'd be starting at year 84. I think if we took Social Security to age 84, there'd be more than a quiet revolution out there. So we've really altered the terms of the game in terms of what the government's going to do to go and offer support to people. Should we change it? I suppose so, but I mean, it's unclear how you go and adjust it, in certain ways. So, I mean, I'm being evasive. I'm being evasive intentionally because I don't think you could change one small thing, leave everything else as is. I think it has to be adjusted. And is that possible? I think we made a good shot at it in the late 90s with Clinton. I mean, I'm an independent. I vote both ways. We did have a balanced budget in the year 2000. And we also had Social Security adjustments where they changed the age and eligibility. I think what's going to happen is Social Security is going to become a quasi-taxable event where it'll be income adjusted. So if you make over a certain amount, you don't get it. That's probably what's going to happen.
Got it. Harley, thank you so much for a wonderful interview. I know you talked about it in the middle, but could you just give the audience, where they can find you and your work?
Oh, thank you very much. I publish, I would say monthly, maybe 8 times a year. I publish on the Convexity Maven.com website. I have lots of good stuff there. I also have a link to my personal website, Bassman.net, which you might enjoy looking at. I have 4 children and we traveled extensively and I have lots of pictures as well as itineraries of trips we took, which are fun. And I advertise, if you want to get added to my list, Harley@Bassman.net. Send me a note and I will go and add you to my list.
Harley, thank you. It was awesome. Thank you.
Thanks, man. Have a good day.